I want to start by asking you a question, and I need you to really sit with it for a moment. When was the last time you truly looked at your cash? I'm not talking about your 401k, your stock portfolio, or your investments. I mean your actual cash sitting in your checking account, your savings account, or your money market account, and asked yourself honestly whether that money is working as hard for you as you work to earn it. Because here's a truth, almost nobody in mainstream financial media will say directly to people in your age group. Cash sitting idle in a traditional savings account in today's economic environment is not safe money. It is slowly dying money. Every single month, it loses purchasing power, while the bank uses it to generate profits for itself, paying you almost nothing in return. And here's the key voice you need to listen to: Stanley Druckenmiller, arguably one of the greatest investors alive today. He has been saying something very specific about cash, about what people should do with it right now, before something happens that forces a decision on them in a way they will not like. If you have cash sitting somewhere and you are between 60 and 75 years old, this message is directly for you. Watch carefully, because the difference between what most people are doing with their cash and what they should be doing could easily represent tens of thousands of dollars over the next 5 years of your retirement. Let me tell you a bit about Druckenmiller, in case you don't fully grasp the significance of his voice. This is not a man who makes predictions from the sidelines. When he ran the Quantum Fund alongside George Soros, he wasn't an advisor or a commentator. He was the one making the actual calls, managing the actual risk, living with the consequences if he was wrong. Later, in his own fund, Duquesne Capital, he ran money for 30 years without ever posting a down year, not one. While ordinary Americans watched their retirement accounts shrink in 2001 and again in 2008, Druckenmiller's clients were protected and often profiting. That isn't luck. That isn't random chance. That happens because of discipline, rigor, and a mindset about money, risk, and the future that is fundamentally different from conventional thinking. And right now, that discipline is sending a very clear message about cash and what the smart move is for anyone who wants to protect what they've built. At the core of Druckenmiller's current thinking is a concern about something called financial repression. Let's break this down, because understanding it is crucial for anyone relying on savings today. Financial repression occurs when a government with enormous debt keeps interest rates artificially low or allows inflation to exceed what savers earn on deposits. It quietly transfers wealth from savers to the government and borrowers. Essentially, it's an invisible tax on people who did the right thing, those who saved instead of spent, those who were responsible rather than reckless. And ironically, it hurts the people who deserve it least, retirees and near retirees who spent decades building up savings to fund their daily lives. Consider what happened from 2008 to 2022. For 14 years, the Federal Reserve kept interest rates near zero. If you had retirement savings in a bank account during that time, you earned almost nothing. Meanwhile, inflation steadily eroded the purchasing power of every dollar. $100,000 in 2008 had the buying power of roughly $70,800 by 2022. Not because the account balance dropped, but because prices rose and your savings did not keep pace. That's financial repression in action. Druckenmiller warns that we are entering a new phase of this phenomenon, potentially more aggressive and damaging than before. This is fueled by a government managing $34 trillion in debt and a political system unwilling to address it through the more honest but painful means of spending cuts and tax increases. So, what does Druckenmiller advise? Practically speaking, the answer requires a fundamental shift in how you view cash. Most people think of cash as safe, the thing you hold when everything else feels risky. Technically, $100 in cash today is still $100 tomorrow. But in an environment of persistent inflation and government debt monetization, the real enemy isn't market volatility, it's purchasing power erosion. Cash in a low-yield account is the asset most exposed to losing value over time. The first mindset shift Druckenmiller emphasizes is simple but critical. Stop thinking about protecting your dollars and start thinking about protecting your purchasing power. These are not the same, and confusing them can be one of the costliest mistakes a retiree can make. So, what does protecting purchasing power look like for someone in your position? Let's go step by step, because vague advice won't help. The most immediate action is moving cash from accounts, paying almost nothing into instruments that at least match or slightly beat inflation. Right now, there are genuinely safe options most people in your age group aren't using. Treasury bills, high-yield savings accounts at federally insured online banks, government money market funds, and I-bonds, the inflation-protected savings bonds issued directly by the U.S. Treasury. Treasury bills are short-term government debt obligations. You lend money directly to the U.S. government for periods ranging from 4 weeks to 52 weeks and receive your principal plus interest at the end. Rates are currently in the 4–5% range, far better than the fractions of a percent most traditional banks offer. They carry virtually no credit risk and can be purchased directly through treasurydirect.gov with no fees and no minimum purchase above $100. Shifting cash from a savings account paying 0.5% to T-bills paying 4–5% is a simple, low-risk decision that can have a real impact. On $100,000, that difference is $4,000 a year, enough to cover groceries, medications, or a family trip. Yet most people leave this money on the table every year out of habit. High-yield online savings accounts are the second option. Online-only banks, with lower overhead costs, now offer rates in the 4–5% range. FDIC insurance protects these deposits just like it does at traditional banks. The only difference is the absence of a physical branch, but the gain in interest often outweighs that. Money market funds holding government securities are the third option. Offered by brokers like Fidelity, Vanguard, and Schwab, these funds invest in short-term government debt and pay out interest daily. While not FDIC insured, they invest in government-backed instruments with a strong track record of preserving capital, offering both liquidity and yields in the 4–5% range. Now let's talk about I-bonds, because this is where Druckenmiller's advice really shines for retirees concerned about inflation. I-bonds are issued by the U.S. Treasury, and their interest rate is directly tied to the Consumer Price Index. This means they are explicitly designed to protect your money against inflation. If inflation runs at 8%, I-bonds pay roughly 8%. If inflation drops to 4%, they pay 4%. On top of that, the interest from I-bonds is exempt from state and local taxes, an especially valuable feature for retirees in high-tax states. There is a $10,000 annual purchase limit per person, which might seem restrictive, but for a married couple, that's $20,000 per year that can go into an instrument guaranteed to keep pace with inflation, backed by the full faith and credit of the U.S. government. The only real limitation is liquidity. You cannot redeem them in the first year, and there's a small penalty if redeemed before 5 years. But for money you can set aside for at least 1 year, ideally longer, I-bonds are a powerful tool to preserve purchasing power, fitting perfectly into the strategy Druckenmiller describes. But what Druckenmiller emphasizes goes beyond where to park your cash. His framework is about understanding the broader economic environment and positioning yourself structurally to withstand it. He argues that the relationship between risk and return is fundamentally different today compared to the past 4 decades. From roughly 1980 to 2020, the biggest tailwind for financial assets was the multi-decade decline in interest rates. As rates fell from 15% in 1980 to near zero in 2020, virtually every financial asset, stocks, bonds, real estate, rose in value. This was a 40-year bull market driven by one macroeconomic force. That force has now reversed. Interest rates have risen sharply, and it's unclear whether they will stay elevated or decline again. In this uncertainty, the passive strategy of buy index funds and hold forever may not deliver the same results for the next 20 years as it did over the last 20. This is especially critical for people in your age group because you don't have 20 years to wait for market trends to play out. If you are 65 today and have $1 million in an index fund, a 40% market drop in the next bear market could reduce your portfolio to $600,000. By the time the market recovers, you could be 75, and during that period, you'd likely be selling investments at the bottom to cover living expenses, slowing recovery even further. This is what financial professionals call sequence of returns risk, and it's one of the most dangerous risks for retirees. Druckenmiller's warning about cash and not waiting for the crash is largely a warning about this exact risk. The optimal time to structure your cash portfolio is before a market downturn, not after. Waiting until after the crash is too late. You'll be forced to sell into weakness, locking in losses and missing the recovery. Before the crash is when you have options. To illustrate, let's compare two retirees, both 65, both with $1 million saved. Person A keeps almost all of it in a broad stock index fund, following conventional advice that long-term markets always rise. Person B, paying attention to Druckenmiller's framework, has restructured their portfolio. They keep roughly 2 years of living expenses, about $80,000 in Treasury bills and high-yield savings accounts, earning 4 to 5%. Another portion, around 30% of their portfolio, is in shorter duration bonds and Treasury inflation-protected securities, TIPS. The remaining 50% is in stocks, but focused on dividend-paying, value-oriented companies rather than pure growth stocks. Now imagine a 35% market drop over the next 12 months. Person A's portfolio drops from $1 million to $650,000. Panic sets in, lifestyle adjustments are forced, and they may have to sell stocks at the bottom just to cover expenses. Person B's stock allocation also drops 35%, but that only affects $500,000 of their starting portfolio, a $175,000 loss instead of $350,000. With a full cash buffer, they don't sell anything during the downturn. They wait, the market recovers, and their financial life remains intact. This structured preparation positioning before the storm is exactly what Druckenmiller means when he says, "Do not wait for the crash." Some people might be skeptical, thinking, "I've heard crash warnings for years, and the market keeps going up. I can't keep rearranging my finances based on predictions that never happen." This is a fair concern, and it's important to understand that Druckenmiller is not making short-term market predictions. He's not saying a crash will happen next month. His focus is structural. He sees conditions ripe for financial disruptions, excessive debt, monetary instability, political dysfunction, and asset price inflation, and is arguing that the cost of protecting yourself now is low, while the cost of inaction could be enormous. This isn't market timing, it's risk management. Risk management is about ensuring that when bad things happen, you are not wiped out, not about predicting exact dates. Druckenmiller also talks extensively about the US dollar. America's ability to run massive deficits relies partly on the dollar's status as the world's reserve currency. Other nations need dollars for trade, to price oil, and as reserves. This global demand allows the U.S. to finance debt in ways other countries cannot. But Druckenmiller, along with other macro investors, warns this privilege is not permanent. The world is slowly reducing dependence on the dollar. If the dollar loses even part of its reserve currency status over the next decade, retirees holding all assets in dollars face significant risk. This doesn't mean converting all savings into foreign currencies or exotic investments. Rather, modest diversification into international assets, gold, real estate, or inflation-protected securities is prudent risk management. Finally, there's a psychological dimension to consider, often ignored. Habits that made you a disciplined saver during your working years, caution, holding cash, avoiding unnecessary risk, can actually work against you in retirement. Back then, Cash was a hedge against income uncertainty. Today, the risk isn't short-term emergencies. It's ensuring your money lasts decades, keeps pace with inflation, and isn't quietly eroded by forces Druckenmiller warns about. Your cash habits need recalibration for retirement. Now let's focus on Social Security, because this is a critical piece of Druckenmiller's framework that directly impacts how you should manage your cash and overall retirement strategy. One of the most significant financial decisions for anyone approaching retirement is determining the right time to claim Social Security benefits. In the environment, Druckenmiller describes one of potential inflation, dollar weakness, and systemic financial stress. Social Security has a feature that is often overlooked but incredibly valuable. It's inflation adjusted. Each year, your Social Security benefit is adjusted upward according to the cost of living adjustment, which is tied to inflation. In 2023, this adjustment was 8.7%, one of the largest increases in decades. This feature ensures that Social Security remains one of the few income streams in retirement that automatically preserves purchasing power, directly countering the erosion that Druckenmiller warns about. This makes the timing of your claim extremely important. For every year you delay claiming Social Security past your full retirement age, up to age 70, your benefit increases by roughly 8% per year. This guaranteed, compounded increase effectively creates a government-backed, inflation-adjusted annuity with an 8% return, something no other investment in the market currently offers with this level of safety and predictability. If your health and personal circumstances allow, delaying your claim to age 70 is one of the smartest moves available, providing a secure, growing income stream for the rest of your life. Bringing all these elements together, Druckenmiller's framework offers a clear, coherent strategy. The first step is clarity. You need to know exactly what cash you have, where it is, what it earns, and how it is protected. Many retirees have finances scattered across multiple banks, brokerage accounts, and retirement plans accumulated over decades. Performing a comprehensive audit of your entire financial picture is the foundation for making intelligent, proactive decisions. Next, you establish a near-term cash reserve. This means holding 1 to 2 years of living expenses in the safest, highest-yielding instruments available right now. Treasury bills, high-yield federally insured savings accounts, or government money market funds. This buffer is crucial. It allows you to weather market downturns without being forced to sell long-term investments at depressed prices. This is precisely what Druckenmiller means when he emphasizes acting before the crash rather than reacting afterward. After securing a near-term cash buffer, you need to examine the remainder of your portfolio through the lens of inflation protection and purchasing power preservation rather than pure growth. Are you holding Treasury inflation-protected securities? Tips. Do you have I-bonds? If you maintain a stock allocation, is it tilted toward dividend-paying companies and sectors historically resilient in inflationary environments? Do you have exposure to real assets like property or commodities that tend to retain value when inflation rises? Systemic risk is the next dimension. How is your cash spread across institutions to maximize FDIC coverage? Which of your assets are most and least protected under severe financial stress? Have you discussed financial preparedness with your family, establishing emergency protocols and contingency plans? Understanding these structural risks and preparing accordingly is what separates retirees who survive turbulent markets from those who are forced to make reactive, costly decisions. Action is the final step, not tomorrow, not after weeks of deliberation, now. Druckenmiller's decades of experience reinforce a simple truth. The time when preparation feels urgent is almost always after it is too late, and the time when it feels premature is exactly when it should happen. Those who protected themselves during the 2008 financial crisis acted in 2006 and 2007, when caution seemed unnecessary, Those who weathered the COVID market crash in March 2020 had built cash buffers and defensive positions in 2018 and 2019, while the market was still hitting all-time highs. Acting while markets function normally gives you options and control that you lose once a crisis hits. This is not about panic or speculation. It's about understanding structural risks and responding intelligently. The crash may not happen tomorrow. Inflation may or may not accelerate. Banks may face stress or they may not. But the person who is prepared for all possibilities will sleep well at night, confident that their financial foundation is intact. The person who waits for confirmation, hoping the storm will pass, risks losing not just money, but peace of mind. A critical nuance of Druckenmiller's advice is the interplay between cash positioning and broader portfolio allocation. It's not just about moving cash to high-yield instruments. It's about creating a cohesive system where liquidity, inflation protection, and risk mitigation all work together. For example, your near-term cash reserve ensures you never have to sell stocks at a loss. TIPS and I-bonds preserve real purchasing power. Dividend-paying stocks provide income and some inflation resilience. Real assets and modest international exposure diversify against currency and systemic risks. Combined, these strategies create a structure where each component supports the others, reducing vulnerability to any single market event. Druckenmiller also highlights the psychological aspect. Retirees often struggle to update their mindset. The habits that made you a disciplined saver, caution, skepticism, hoarding cash, worked well during accumulation but can be detrimental in the distribution phase. In retirement, the risk is not losing money in the short term, it's ensuring your money lasts decades, maintains purchasing power, and withstands structural economic shifts. Recalibrating your cash habits for the new reality is essential. Finally, Druckenmiller's principles underscore the importance of proactive decision-making. Waiting for confirmation or reacting to market events removes your ability to act with clarity and control. Preparing before conditions deteriorate allows you to execute strategies deliberately rather than reactively. It ensures that when the market shifts, when inflation accelerates, or when systemic risks materialize, your financial life remains resilient. To make Druckenmiller's strategy truly tangible, let's walk through a concrete example of how this framework looks in real life. Understanding abstract concepts is one thing, but translating them into specific decisions is where real financial security is built. Consider two retirees, both 65 years old this year, each with $1 million in total savings. Person A follows the traditional approach, keeping the bulk of their money in a broad stock market index fund, trusting that over the long term, stocks always go up. Person B, however, has been paying attention to what Druckenmiller and other seasoned macro investors are saying and has structured their portfolio with careful attention to risk, liquidity, and inflation protection. Person B's strategy starts with a cash buffer. They set aside 2 years of living expenses, approximately $80,000 per year, in safe, high-yield instruments like Treasury bills and high-yield federally insured online savings accounts. This ensures that no matter what happens in the market, they will not need to liquidate long-term investments at an unfavorable time. The remainder of their portfolio is strategically diversified, about 30% in shorter duration bonds and Treasury inflation-protected securities, 50% in dividend-paying value stocks rather than pure growth stocks, and a small allocation in real assets such as real estate or commodities. Now imagine the market experiences a sharp 35% decline over the next 12 months. For person A, their $1 million in the index fund falls to $650,000. Because they lack a cash reserve, they are forced to sell equities at the bottom to cover living expenses. This crystallizes losses and slows recovery, putting their retirement lifestyle at risk. In contrast, Person B's $500,000 stock allocation drops by 35%, costing them only $175,000. Meanwhile, their cash buffer covers 2 years of expenses without touching investments. They don't sell at the bottom, and when the market recovers, their portfolio remains fundamentally intact. This is the real-world impact of positioning your cash and investments before a downturn rather than reacting after it happens. Druckenmiller stresses that this approach is not about predicting exact timing or the magnitude of a market crash. It is about acknowledging the structural conditions that increase risk: massive government debt, monetary instability, political dysfunction, and potential inflation, and acting preemptively. Risk management is not speculation. It is about ensuring that when disruption occurs, you are not wiped out, and your financial choices remain intact. Waiting for a confirmed crisis leaves you reacting under pressure, often making costly decisions driven by fear. Another aspect of Druckenmiller's thinking relates to currency risk and the long-term health of the dollar. The United States enjoys a unique advantage. The dollar is the world's primary reserve currency. This allows the government to finance enormous deficits more cheaply than other countries. However, this privilege is not permanent. International trade dynamics are slowly evolving, and global reliance on the dollar is gradually decreasing. For retirees holding all their wealth in dollar-denominated assets, this presents a potential risk to purchasing power over the coming decade. This does not mean converting all savings into foreign currencies or exotic investments. It means considering modest diversification, a small allocation to international equities, gold, real estate, or inflation-protected securities. These assets can serve as hedges against long-term currency and systemic risk, ensuring that your financial future is not overly dependent on the strength of the dollar alone. At the same time, Druckenmiller emphasizes the importance of adjusting to the psychological realities of retirement. Habits that were advantageous during accumulation caution, holding cash, avoiding risk, may now be liabilities. In retirement, the challenge is no longer protecting against job loss or short-term emergencies. It's about making sure your savings last decades, keep pace with inflation, and maintain purchasing power. Recalibrating your cash management and investment habits for this new reality is essential to avoiding the hidden erosion of wealth over time. Druckenmiller's framework also highlights the critical interplay between cash management and the broader portfolio. A cash buffer provides security and flexibility. Inflation-protected instruments like TIPS and I-bonds preserve real purchasing power. Dividend-focused stocks generate income and maintain resilience during inflationary periods. Real assets offer tangible protection against rising prices. The combined effect is a structure where each component reinforces the others, reducing exposure to market volatility and systemic shocks. The essence of his message is that preparation must precede crisis. The best time to position yourself is when conditions are still normal, when markets are functional, and when your options are not constrained by panic or necessity. Those who wait for a crisis to react lose the ability to choose. They sell at the bottom, miss recovery, and compromise decades of retirement security. Those who act early gain control, preserve wealth, and maintain lifestyle stability. Finally, action is paramount. Druckenmiller's experience across 50 years in finance shows that the window for effective preparation always feels premature until it's too late. When the market crashes, the opportunity to implement a low-risk, high-value cash and portfolio strategy is gone. By acting now, auditing your finances, creating a cash buffer, diversifying thoughtfully, and protecting purchasing power, you are taking control of your financial destiny rather than surrendering it to chance. This approach does not guarantee a market crash, accelerated inflation, or bank stress. It guarantees, however, that if any of these occur, you are prepared. You sleep better at night knowing that your finances are resilient. You avoid the panic, the forced selling, and the regret that follow financial shocks. You retain choice, flexibility, and security. In essence, Druckenmiller's advice is about deliberate, informed action. It is about applying decades of macroeconomic understanding and risk management to your own retirement strategy. You do not need to be a billionaire to benefit from these principles. You only need to think clearly, act deliberately, and respect the realities of today's financial environment as seriously as you did the realities of your working life.